Okay, well, it looks like we're at 4 o'clock. So I think we better just kick things off here in the interest of time. Sounds like you guys can hear me okay. Alrighty. Well, to everyone on the line, welcome to the first of what we hope to be many Blue Chip Partners live webinar. By way of introduction, in case I haven't met any of you or spoken with any of you in the past, my name is Daniel Dusina. I serve as the Director of Investments here at Blue Chip Partners, leading the investment committee and overseeing the broader in-house investment department. So in terms of logistics for today, we are planning on having 20 minutes roughly of prepared remarks and leaving about 10 minutes for questions at the end. Any participants should feel free to submit questions using the chat functionality in the Teams meeting, and we look forward to addressing those at the end. So in addition to myself on the line, we also have Dan Seder, Managing Partner, and Matt Mondoux, Senior Financial Advisor. In terms of an agenda for today, I will be walking through some items on the consumer aspect of the economy, where we are right now, where we think we're going, as this is a very vital component and really the backbone of the U.S. economy. I'll then turn it over to Dan Seder, who will walk through some headline stock index performance and why that may not be necessarily all that's happening beneath the surface. Finally, Matt Mondoux will touch on margin debt in the market today, some of the implications that's had year to date on performance, and some direction in which margin debt might impact the market in the future. So as we start off here, as I mentioned, the consumer spending aspect of the U.S. economy really does account for the lion's share of gross domestic product, 70% to be more precise. And so to be clear, as we look at the space today, consumers in the U.S. really still are in a very strong financial position in aggregate, but we do see the winds of change blowing a bit. And so more specifically, over the last 2 weeks, we have identified some very helpful insights from companies in the retail space. Specifically, I've bucketed these insights into 4 categories. First, related to staffing. Second, related to elevated inventory levels. Third, related to a shift in spending patterns. And finally, a trade down the cost curve in terms of consumer preferences. All of these items do have some read-throughs for the pace of inflation going forward, which is why we think it's important to highlight today. When we look at staffing in the United States, 2 of the biggest employers in the United States, Amazon and Walmart, recently highlighted that they may be slowing their hiring as they appear to be overstaffed at this point. This is a very stark change of direction for these 2, as they were massively staffing up over the last 2 years to satisfy excess demand. A reduction in hiring could dampen job creation, which is an important driver of the economy. However, as both of these employers tend to be above average payers in the marketplace, a reduction in hiring could slow wage gains, which tends to be a long-term driver of inflation. And we certainly have seen that wage growth prop up inflationary figures, those year-over-year price increases over the last year and a half. If we do see wage gains decelerating, which we believe we will, it could help slow the pace of inflation a little bit more naturally. On the inventory front, inventory levels have been growing. In fact, retail inventories reached a record level, a record high back in March. Several retailers like Target recently admitted that they failed to anticipate the pace at which consumer spending would shift from categories such as TVs and kitchen appliances, which were very big winners and very big spending categories through the pandemic, over to luggage and toys for birthday parties and attire for events. So regardless, with inventory levels in many cases 20% higher than average across the board at retailers, a reduction in inventory is likely to lead to a more discounting in the industry, and that, as we see it, can place downward pressure on inflation. Thirdly, looking at shifting spending patterns, we think this is very important to take a look at today. The charts I'm sharing with you on the screen show the personal consumption expenditures portion of gross domestic product. Put more simply, this is the consumer spending aspect that accounts for roughly 70% of underlying U.S. economic growth. On the left-hand side, we see this consumer spending on goods versus its long-term pre-pandemic trend, which is the period from 2002 to 2019, which gives you a nice read on the long-term average growth rate. And on the right, we see the services component of consumer spending. And what you'll see is that spending on goods has been massively above the long-term trend line. And services, however, are just now starting to catch up. While spending on goods has slowed, and we do think that will continue to be the case over the next 6 months, we don't want to over dramatize this dynamic, as we were expecting a shift in spending from goods to services as the reopening of the economy becomes a little bit more sustainable. Several services-oriented industries are benefiting from the economy reopening right now, and it's happening before our eyes. For example, Delta Airlines has seen business travel volumes reach its highest level post-pandemic, and overall travel volumes, as represented by the Transportation Security Administration throughput, just last week reached its highest level over the last 2 years. Further, Carnival Cruise Line boasted its best week of booking volume since guest operations resumed, and hotel operator Hyatt noted that resort bookings for the summer were up over 60%. So while spending on things like vacations is likely to remain strong through the summer, so you see that shift on spending on goods towards spending on services, the expectation is that this pent-up demand will start to slow as we go into the fall, again, placing a little bit of a ceiling on inflationary pressure. And finally, we're seeing consumers start to trade down the cost spectrum and substitute some of the more private label and generic options for favored brand names. Both Target and Walmart recently noted that consumers were becoming more cost conscious, shifting purchases to those lower cost generic options rather than the brand name labels, which may require paying up some of the time. The latter, or Walmart, also acknowledged that some of the growth has been driven by fuel purchases, as spending for other discretionary needs was actually pretty muted, which again speaks to us in terms of the pent-up demand that we saw coming out of the pandemic starting to be quelled a bit. Overall, this type of shift or bargain hunting suggests that consumers, particularly at the lower end of the income spectrum, are starting to struggle and feel the pinch of inflation. In response, more costly brand names are being forced to either innovate or defend their value proposition. For example, a company like Procter & Gamble recently seen being advertising the efficiency of its laundry detergents and has rolled out easy squeeze bottles for its dish detergents so that no drop is wasted. And Clorox recently stated that they would increase promotions should the consumer show signs of more cost-conscious behavior. So all of these factors taken together, we do see the consumer still in a very strong footing financially, but we do think that some of these factors, especially the trade down in consumer preferences, speaks to the need for selectivity, which we've been calling for the last 6 to 9 months. We're really looking for businesses that are competitively advantaged and do provide some semblance of a value proposition in which they can continue to provide benefit to consumers. This is what we would term as quality in the equity landscape today. At this time, I'm going to shift the conversation over to Dan Seder, who's going to talk a little bit about headline index performance on the equity side this year, as well as some underlying details and explain why the headline index performance may not always be the best representation.
Great, thanks, Daniel. And just to confirm, everyone can see my screen as I shifted over. Perfect. Okay, great. I get to talk about headline index levels with the S&P 500 year to date down 17.3% through last night's close. And so what I wanted to talk about was the difference between that metric, which the media focuses on as the stock market, and the market of stocks. And there's really two major differences. And so if we're slowing down and just recognizing what is the stock market as referred to on CNBC or the financial media, and what does it consist of? And so if I flip up to a quick breakdown of the weighting, I first want to point out that the S&P 500 is market cap weighted. Market capitalization stands for size of company, and it's calculated by taking the stock's price times its number of shares outstanding. And when you look at the largest company in the world, like Apple, which today has a market cap of $2.2 trillion, it represents, this is as of March 31st, over 7%, one company represents over 7% of the S&P 500. And so what's notable is that over time, the top holdings in the S&P 500 have turned out to be technology and growth related stocks: Apple, Microsoft, Amazon, Tesla, and Google. And so just to put it in perspective, Apple at $2.3 trillion, and General Motors, another company that we're all familiar with, at a market cap of roughly 51 billion, Apple takes on roughly 44 more times your dollar that you invest in the S&P 500. And so when you invest in the S&P 500, a majority of the money is going to the top names as weighted by market cap. And so as we see below in top sectors, over time, technology, consumer discretionary, these are some of the most heavily weighted segments. And so the performance of those segments and those companies are going to hugely influence that headline number that the media talks about. So let's look at that. So here's the S&P 500 through last night's close, down 17.3%. We actually touched intraday on Friday what they call bear market territory, where the market went down 20%. So for some reason, 19% is still a bull market, but if you hit 20, that's considered a bear. That stat has no significance at all. But here we are, and here we stand today at 17.3%. And if we look at Apple, Microsoft, Google, Amazon, and Tesla year to date, what we can see, if I box those numbers, is those numbers all come out to be down 20, 22, 26, 37, and 40%. So significantly worse off than the average or the index at 17.3. So those stocks being down, but being the most heavily weighted stocks in the index. So on the flip side, if I think about, well, what's working well? Are there companies out there that are actually performing well in this environment? Sure, there absolutely are. If you look at some of the equal weighted companies in the energy index or the utility index, the energy index is up nearly 53% and the utility index is up nearly 7%. So to put that in perspective with some real world companies, Chevron up 47 and DTE up 12. And so the smaller companies or the smallest companies in that market capitalization structure are doing well. Some of them are. They're performing. The largest companies are struggling, and the largest companies are pulling the index or headline level of the stock market down, and that's what the media is reporting on. The media isn't telling you necessarily about the companies in the market of stocks, not the stock market, but the market of stocks that are actually doing well. So there's a measurement of that, and we can see it right here. It's the S&P 500 equal weighted index. That index today is down about 12.5%, so it's not all roses, but it's certainly not as bad as the headline S&P 500 that's weighted by market cap, down 17.3. So that equal weighted component of the S&P 500 is outperforming by about 5% year to date. And why I think that matters for investors is it's easy to get caught up in the headline number and to think that this is all doom and gloom and that the markets are crashing. Some companies are crashing, right? Some companies are doing worse than others, but there's certainly plenty of opportunities out there in other segments that for the last 10 years haven't been exciting or popular or the place to invest. But today they are, and when you actively manage a portfolio the way we do here at Blue Chip, I think it gives us the advantage in a market environment like this, particularly when those biggest companies that are hurting the S&P are struggling. So with that, I'll pass the mic over to Matt Mondoux and stop sharing my screen.
Thanks, Dan. And Daniel, if you would not mind sharing the slide deck. Perfect. So this chart is going to come through. It's a little tough to see some of the numbers, but I'll verbally point them out and kind of give you an idea of what we're trying to illustrate on this chart. And this takes Dan's period, and we're just going to look a little further back and kind of just give a quick recap of what has happened in the markets since the pandemic, since before the pandemic began. So the white line there is meant to illustrate the pre-pandemic peak in the market, February of 2020. all the way up to the post-pandemic peak of the market, which would be December of 2021. So almost 2 years, 2 years period there of the markets. And what you'll notice, or what that white arrow illustrates, is the fact that from peak to peak, we were annualizing at over 20% per year. If there's one thing we know about the markets, it's that we don't annualize at 20% per year. Often it's more assumed to be high single digits, low double digits, somewhere in the 8 to 10% range tends to be a more comfortable annualization period or return. And a lot happened over those almost 2 years. We had GameStop, we had AMC, Robinhood, SPACs became a thing, Bitcoin and other cryptocurrencies, all the way to non-fungible tokens or NFTs. There was a alphabet soup of things that were talked about in the media, on Wall Street, in the local news, and almost all of those things had nothing to do with long-term investing. It was all short-term speculation fueled by low interest rates and I would say some type of animal spirits that were stoked by the constant stories of money being made in returns in speculative markets. So fast forward to today, recognizing that was our backdrop coming into December. What you'll notice, the red arrow there, shows us from the pre-pandemic peak, February 2020, to now, we're annualizing at about 7%. So this correction has gotten us a lot of the way of getting us back to what we would assume a long-term sustainable market average return to be. And often that can set us up as a base for future returns that can be hopefully in that more sustainable 7 to 10% range. But that was important. Continuing to analyze at 20% was just not going to be realistic. And Daniel, if you'll flip to our next slide here, I just want to talk about one reason or one illustrative example of what drove some of that. So this is something we talked about earlier in the year. We highlighted in the Q1 quarterly edge. This is an update to that chart. And it's specifically margin debt. In a nutshell, margin debt is leveraging your current portfolio to buy additional securities, financial securities, through a loan from a broker dealer. So if you had $1 million portfolio, the broker dealer was offering you to buy $400 of securities on margin, you would have $1.4 million of securities, but you would eventually need to pay back the $400,000 that you owed. As you can imagine, market's up 10%, you did really well. Unfortunately, it's amplified to the downside as well, returns, and that return down 10% wouldn't be $100,000 loss, it would be $140,000 loss. So that can create a negative feedback that can spiral as people look to cover margin debt, which is more expensive to borrow as interest rates have gone up. Very cheap to borrow on margin when rates are super low. As rates have come up, you can see margin debt contracting. And we ultimately believe that's going to be another healthy thing for the markets going forward. That the tannish gray line there is the 15-month rate of change, how quickly margin debt had exploded during the pandemic period. It almost doubled. So here we are in a period of uncertain economic times, and you're having margin debt double by hundreds of billions of dollars. That to us was not going to be sustainable. And in some ways, it's comforting to see some of the margin balances work themselves off. Unfortunately, we do believe that's concentrated itself in a lot of the large cap tech space that Dan highlighted. That's a big driver of negative returns because those would be the most likely companies that were bought on margin. They're still great companies. We still believe in Google, the Googles, the Apples, the Microsofts of the world. But to cover margin, the result is to sell the stock to do so. So we could see a little more contraction here, but we would see this as, from a margin perspective, some of the worst being behind us from that standpoint. So with that said, I will turn it back to Daniel. It would be great if anybody had any questions, add them to the chat box. If not, we may chop back and forth and ask ourselves some questions and just get some more commentary going. Thank you.
Great. Well, thanks, Dan and Matt. We do have a question that's come in through the chat, and for everyone else on the line, do feel free to continue to chime in using the chat function if you have any questions. We'll look to address them. Dan, it looks like we got a question that is related to blue chip rebalancing its holdings to take advantage of better performing market sectors. I can give a brief level of insight on this, and I'll turn it over to you. What I would say is that coming into this year, we made some measured moves and continue to make those measured moves on a year-to-date basis. Those measured moves were very much consisting of a tilt away from some of the hyper growth of expensively valued securities, some of the securities that worked very well coming out of the pandemic, and shifting our allocations a little bit more towards some of the more stable, attractively valued, resilient, blue chip businesses, if you will. So tilting towards value, that is evidenced in some of our trades this year in the utilities space, in the staples space, and so on. So while we do tend to be diversified across the 11 GIC sectors, as we think there are clear diversification benefits, we have made measured moves to allocate capital towards areas of the market that we believe are ripe for an environment that has higher inflation and tighter financial conditions. Anything to add, Dan?
Yeah, thanks, Daniel. That was great. So no, you named off a few of the moves that we made, and I would add, some. You said industrials to that list as well that we added to. But the one thing that I did want to add is when you look at the weighting of some of these stocks, and I'll just go back to the top 10 holdings that I talked about before in the S&P 500. We were inherently underweight these positions, or many of these positions, going into the year. So part of the rebalancing that Daniel discussed was active on our end. So it was an active decision to make some measured moves. We did that in January, February, March. Actually, basically pretty much every month thus far year to date. But just as it stood from the allocation going into the year, because we were already significantly underweight information technology, for example, we didn't have to go in and chop technology down as much as many other firms or many other investors. So we were already positioned underweight some of these overinflated segments going into the year. And I think that also was taken into consideration as part of our rebalance.
Yeah, I definitely agree with that, Dan. Just to the group, please feel free to keep sending in any questions you have. I do have one for you, Dan and Matt, that I think might be beneficial for the broader audience to hear about. With the environment that we find ourselves in from an interest rate perspective and the inverse relationship between bond yields and bond prices, aka as bond yields rise and interest rates rise, bond prices fall, do you think that bonds can still provide a reasonable hedge against volatility in this time?
Matt, you want to take that one?
Yeah, I'll start. Great question, Daniel. So the move upwards in interest rates has been pretty dramatic. The market has the benefit now of the Federal Reserve being highly transparent and really telegraphing what they're going to do. So you got to think of the bond market as front running the actions of the Fed. The market has priced in many rate hikes already. So there isn't much more from the bond market standpoint to price in because moves have been so well telegraphed. What I would say is, as we look at yields, and we tend to look at a benchmark yield, a 10-year treasury, for example, we have not yet gone above the last tightening cycle from a rate standpoint in 2018. And in fact, the rates are still below where we were at in 2018. I would expect given we've had a 40-year bull market in bonds, as interest rates peaked in the early 80s and perhaps bottomed out during the pandemic of 2020, to have some type of long base be built within rates as they're chopping sideways. So I do believe that they're going to provide a hedge going forward. I do think the interest rate moves to the upside are likely priced in, and they will go on to be a better hedge for equity market volatility going forward.
And I guess the one thing that I would add to that, I agree. I think that bonds still have a place in a portfolio, but the move thus far has been really surprising, and how bad bonds have taken it on the chin relative to past environments. And typically, when stocks go up or go down, for that matter, you get some type of counterbalance in bonds for that risk that you're taking in stocks. And unfortunately, this year we haven't seen that. Bonds, with the hike in rates, have really taken it on the chin. Sentiment is really bad when it comes to bonds right now. People hate the fact that the ballast of the portfolio is going down, and so sentiment is almost so washed out that it makes me want to be a contrarian. It only would take a few comments from the Fed going out there and instead of hiking 50 basis points, some lower number, or kicking the can slightly further down the road, if some of these headline inflation numbers truly are behind us, for the bond market to rally from these levels. So I don't love the ride down, but at the levels that we're at today, I think they absolutely still deserve a position in the portfolio for a long-term investor looking to hedge some of that stock market risk.
Yeah, and even just to tie a bow on it, we've been fairly vocal in our client communications with regards to the fact that fixed income is a space that has a place in every portfolio, and it's a part of the market in which we generally don't have to be incredibly active. It's not a set it and forget it type of allocation, but given our perspective as long-term investors, generally speaking, we've been blessed with not having to make significant alterations to the fixed income side of client portfolios. Having said that, this year we have been incredibly active. We do envision an environment for the remainder of the year in which we do need to stay on our front foot. And so, just as Dan was alluding to, there are getting to be some fairly attractive yields in the space today. So as we look forward through the rest of this year, we will be anticipating making some additional measured moves in the space, depending on how the underlying market, the underlying economy, and the Federal Reserve decision-making process begins to unfold. So I don't see any additional questions in the chat at this time. So with that, basically just going to say that we greatly appreciate your time today. Hopefully this was an insightful conversation for everybody on the line. I'll speak for myself, Dan, and Matt, in that we look forward to having these types of conversations with you all in the future as we look to cascade some of our in-house views to our client base. Just a note is that this webinar will be available for replay as it's been recorded. So in addition to being housed on our Blue Chip Partners blog, this will be sent out via an email with a link to the location on the blog for which anyone can share that and view it at their leisure. Thank you all again very much for the time, and we look forward to talking to you again in the future very soon.